Hey everybody, I'm Ernie from Shark Investment Research. Well, you may not have been able to get to the restaurants these last few months, but you still had to get to the grocery store, and one way or another, all those food products had to get delivered. Come on, we're going to dive in and take a look at the retail food industry. We've got two very interesting contenders for your dividend investment dollars. One's Canadian, one's in the US. Come on, let's see how they stack up.
Our focus is dividend stocks, but before we even consider a company, it first has to pass our very rigorous qualification requirements. And that means one of the six things: increasing cash flow, earnings, or dividends per share for the last 17 years, or in the case of cash flow and earnings, we'll allow them a flat year or a negative year, one only. And in the case of dividends, we'll let them have a flat year, but no negative years. I believe you'll agree that before you even get into the list for consideration as a dividend stock, this is pretty tough. And now on top of this, you better be throwing something off more than, like 2% average, or I'm going to have a hard time even considering you. Now, that said, one of our contenders for the retail food industry is not quite a 2%er, but I'll explain why when we get there. So our first company for consideration here is Empire Company Limited. Their ticker is EMPA.TO. They are a Canadian company. Their dividend yield is only 1.3%, and that's on $39.38 a share, effective 16 October 2020. So you're probably scratching your head saying, well, if they're only 1.3%, why are we even looking at them? Well, because if I didn't include them, I wouldn't have two companies to look at in the comparison. Yes, in the retail wholesale food industry, it was hard to find companies qualified with the 17-year increasing requirement. So that was the first part. But the second part I think you'll also find interesting for consideration. Empire Company is a Canadian company, and they're operating primarily in the food retail business through their subsidiary Sobeys. They also operate IGA, Safeway, Thrifty Foods, Foodland, and Fresco locations, 1,500 outlets throughout every province in Canada. And some of them also sell fuel, Fast Fuel, Safeway, and Shell. So this gives you access to Canada if you want to diversify your portfolio a little bit, but you're still only getting 1.3%. All right, now on to the details here. They are not qualified for cash flow or earnings, but they are qualified as a Div 0, so 17 years of increasing dividends per share. No flat years in here. All right, let's look at the long-term trend. Okay, now this is a generally upward profile, but they've got some ups and downs, and they got this huge spike here. There was a big split going on here. So let's see, what was that? That was a 3-for-1 split that happened there. So that explains what you're seeing right there. In the year to year, if we take a look, we see the ups and downs going on here that disqualified their cash flow and their earnings per share. And you just barely see the little gold blobs. Their dividend year-to-year change is always positive. As we saw, their Div 0, it just isn't, doesn't stand out in this scale. All right, now let's compare them to a company that I'm sure you've probably seen their trucks when you're out driving around, Sysco Corporation, ticker SYY. This is US. Their yield is 2.8%. on $63.54. And again, that's valid 16 October 2020. Now, Sysco, of course, took some hits this year because of COVID and their inability to deliver to a lot of restaurants and such, but they still had to make deliveries to hospitals, retail outlets, those kind of things. So they were still out there. They were not qualified for cash flow or earnings per share, but they are qualified as a Div 0. So 17 years of increasing dividends per share with no flat years. Here's what that looks like. On the long-term trends, you can see a slow upward kind of, and then a good upward trend here. They were really getting it together, and then we got hit, okay? So, but their dividends have always been a nice, relatively smooth upward progression. The year-to-year really shows this big hit, but it more clearly shows that the dividends have always been positive. All right, let's lay them out one on top of the other. Here's the cash flow per share. Empire is in the blue solid line, Sysco in the red dotted line. Kind of back and forth. You got Empire outperforming Sysco up to about 2012. Then Sysco comes in because Empire stumbles. They come back. They do the stock split. Sysco's outperforming consistently again. So a lot of exchanging places here on the cash flow. In the earnings per share, we see that for the most part, Sysco is kind of outperforming all the way up until we take this hit here in 2019. So you've got Sysco doing a pretty good job of staying on top of things, but Empire's doing a good job as well. All right, the dividends per share, let's face it, that's what we're talking about. Dividends, you got Sysco at 2.8. So it's really not that much above the averages. That's on $63.54. Empire below average at 1.3%. Again, I'm not saying that you should buy one or the other, but if you're looking to put retail, wholesale food in your portfolio, these are the only two companies that passed my very rigorous demands for 17 years of increasing cash flow earnings or dividends per share. And then Sysco's the only one that really rises above the average for dividends. All right, are you planning on adding Sysco? What about Empire? Do you want some Canadian exposure? I'd love to hear what you have to say. If you're enjoying these dividend stock analysis and comparison videos, go ahead, give me a thumbs up and make sure you subscribe. That's that little red button in the lower right-hand corner. Don't forget to tell your friends so that they can be better informed investors as well. There's going to be some links popping up here to some of my other videos. I hope to see you again on the next one.